The jobs report dropped. Headlines screamed strength. Gold and silver were instantly slammed. Equity markets popped for a few hours as if prosperity had just been confirmed. Financial media celebrated the resilience of the labor market. But buried beneath that headline was something far more important. The revision data quietly revealed that employment had been overstated by more than 1 million jobs. 862,000 removed in a single benchmark adjustment, the largest downward revision since the 2009 financial crisis. Total job growth for 2025 was revised down to just 181,000 jobs for the entire year. That averages out to roughly 15,000 per month. For comparison, 2024 supposedly added nearly 1.5 million jobs. That isn't a slowdown. That's a collapse, disguised in real time by headline manipulation and corrected months later when no one is paying attention. Meanwhile, as Western markets were smashing metals on the initial jobs headline, the Shanghai premium on silver doubled to $6. Western spot traded near 84. Shanghai physical traded near 90. Futures in Shanghai pushed even higher. A $6 premium is not noise. It is not normal arbitrage. It is a physical market signal screaming that something underneath the paper structure is tightening. If your first reaction is that this sounds exaggerated, good. That reflex didn't develop by accident. For decades, skepticism has been carefully trained to flow in one direction, toward alternative analysis, while establishment data is accepted at face value. Institutions benefit when people dismiss anomalies before verifying them. They win when no one pulls primary documents. So don't trust me. Verify it yourself. Read the BLS benchmark revision report. Pull the COMEX delivery data. Look at the commitments of traders' reports. Check the Shanghai Futures Exchange numbers directly. All of it is public. When you actually examine case numbers, fine amounts, federal court settlements involving market manipulation over the last decade, it stops sounding like conspiracy and starts looking like documented history. Now consider what just happened. The headline jobs number beat expectations. Metals dropped instantly. Algorithms responded exactly as programmed. Yet the revision revealed prior months were massively overstated. 3 straight years this pattern has repeated. 2023 revised lower, 2024 revised lower, 2025 revised even further lower. At one point, employment was overstated by more than 1 million jobs compared to actual payroll records. Markets react to headlines. Reality hides in revisions. And while the paper price was slammed, something else was building. February silver deliveries on COMEX reached approximately 23 million ounces, over 45,000 contracts issued for delivery. That amount exceeded 100% of the open interest that existed in the February contract at the end of January. When deliveries exceed the entire starting open interest of a contract month, it signals aggressive physical demand overwhelming prior paper positioning. March now carries open interest representing roughly 342 million ounces of silver claims. First notice day approaches at the end of February. That's when traders must either declare intent to take physical delivery or roll their contracts forward. If delivery percentages resemble February, the exchange faces one of the largest physical stress tests in modern history. At the same time, the Shanghai Metals Exchange closes for Chinese New Year for over a week. During that window, Eastern physical buyers temporarily step away. Historically, periods when Shanghai is offline have coincided with increased volatility and aggressive paper selling in Western markets. Without Eastern physical demand absorbing supply, Western banks can push futures prices lower with less resistance. But this year there is a difference. Shanghai's silver market is already in record backwardation before the holiday even begins. The front-month contract is trading at a premium to the next active month, a condition typically associated with near-term scarcity. Backwardation of this magnitude is often driven by inventory depletion and urgent physical demand. Solar manufacturing demand, investment bar accumulation, and shifting global concentrate flows are straining deliverable supply. Short sellers are reportedly paying deferral fees to avoid delivery. That is not typical speculative behavior. That reflects tightness. At the same time, broader economic data paints a deteriorating picture beneath surface stability. 9 large U.S. companies filed for bankruptcy in a single week. The 3-week rolling average sits above 6 major bankruptcies per week, levels not seen since the COVID era. Consumer debt delinquency rates have climbed to nearly 5%, the highest in roughly 8 years. Household stress is building quietly. Yet commodities have surged over the past year. Silver has risen dramatically. Gold has advanced substantially. The dollar has weakened. That is not evidence of economic health. It resembles currency debasement colliding with supply constraints while nominal asset prices inflate. Equity markets reflect confusion rather than confidence. Indices whipsaw intraday. Crypto markets shed tens of billions in capitalization in hours. Bond yields remain relatively flat, refusing to confirm the strong growth narrative implied by headline jobs numbers. The 10-year Treasury yield has barely moved across recent months despite supposedly resilient employment. Bond markets often price economic direction more soberly than equities. Flat yields suggest skepticism. Technically, silver recently dipped below the 150-period exponential moving average on the hourly chart, a level that had served as support for weeks. In prior breakdowns, losing that level led to sharp declines. But this time price reclaimed it quickly. That shift does not guarantee a rally. It does not signal imminent upside. But reclaiming a previously broken support turned resistance can mark structural stabilization. Technical structure is beginning to align with physical fundamentals. That alignment does not mean prices must surge tomorrow. Support needs confirmation. Volume must sustain moves. Retests must hold. Markets can retest lower before larger pressures manifest. There is also a legitimate bearish case. Despite revisions, January still showed job gains. Unemployment remains above historic lows, but not at recession extremes. Corporate bankruptcies are elevated, but not at 2008 crisis levels. Consumer delinquencies are rising, but not catastrophic. Contracts can be rolled forward. Cash settlement mechanisms exist. Exchanges possess tools to prevent visible delivery failures. Paper price discovery has dominated precious metals for decades despite periodic physical tightness. The system has flexibility. But every bearish delay assumes that paper markets retain full control over price discovery. That assumption weakens when physical premiums widen dramatically across regions. A $6 Shanghai premium is not trivial. When Eastern markets consistently pay above Western futures prices for immediate delivery, credibility fractures. If divergence persists, arbitrage eventually forces adjustment. Either physical flows increase or paper pricing must reprice. February deliveries already exceeded the entire starting open interest of the contract month. March carries even larger exposure. If a meaningful percentage stands for delivery, inventory stress intensifies. And here is the broader macro overlay. Employment overstated by more than 1 million jobs. Corporate bankruptcies elevated. Consumer defaults rising. Real economic stress building beneath nominal asset stability. Meanwhile, strategic materials are gaining attention. Exchanges are even considering futures contracts for rare earth elements, critical to defense, energy, and technology supply chains. That institutional recognition signals that resource security matters geopolitically. Whenever futures markets expand into critical materials, the same structural dynamic appears. Abundant paper claims relative to limited physical supply. The system can expand paper supply indefinitely. It cannot print physical metal when delivery is demanded. So what matters now? Watch first notice day for the March contract. Watch how many contracts stand. Monitor daily delivery notices. Observe whether the 150 EMA holds on retests. Track the Shanghai premium when markets reopen after the holiday. Compare Western futures pricing to Eastern physical premiums. Review the BLS benchmark revisions yourself. Confirm bankruptcy filings. Examine consumer debt statistics. Pull the exchange inventory reports. Do not trust headlines. Do not trust narratives, including mine. Trust primary source data. When you study patterns across multiple years, you notice employment consistently revised lower. You see delivery ratios rising. You observe persistent physical premiums that refuse to close. You recognize that commodity strength amid economic deterioration reflects monetary dynamics, not prosperity. This is not a buy signal. It is not financial advice. It is education about structural signals in financial markets. Markets can delay recognition of stress for extended periods. Paper systems can absorb pressure through cash settlement and contract rollovers. Prices can be pushed lower temporarily during liquidity windows. But when physical and paper markets diverge too far, something eventually resolves. Either physical demand subsides, or paper pricing loses authority. The next several weeks provide measurable checkpoints. Delivery declarations, premium behavior, technical structure confirmation or failure, bond market response, continued revision patterns. The establishment narrative focuses on single-month headlines. Serious analysis focuses on revisions, inventory, premiums, and settlement data. You have two choices. Accept surface headlines at face value and assume stability, or verify the underlying data and decide for yourself what is building beneath it. Financial history shows that imbalances rarely correct gently. They build quietly. They appear stable. Then suddenly they are obvious. The warning here is not hype. It is simple. Verify or remain blind to the signals forming in plain sight. Use logic. Ignore noise. Follow primary data. What you do with that information is entirely your decision.